All right, let's talk about why many investors or several investors, at least investors of our fund, choose to diversify away from the stock market or publicly traded companies. Not move their capital all away, but just diversify and allocate. This is our daily parallel brief. We talk all things investments and finances, 2-3 minute clips every single weekday. We put this type of content out. Not advice, not financial advice by any means. Big disclaimer there. But this is just what we see on a day-to-day basis. So why many investors, at least investors within our fund, choose to diversify beyond stocks? There's a few reasons. And first point I'll make is I think investing in the stock market, investing in alternative investments, whether it's private credit, private equity, it can all go hand in hand. I think it can all go parallel with each other. I think it's smart to have allocations depending on what the investor psychology is or what their mindset is and just what they value in general. The stock market, you can have a year where the S&P is 20%, you can have a year where it's 0%, you can have a year where it's -%, you can have a year where it's 10. So it kind of spikes. Now, over the course of 10, 15, 20 years, if you go and just type in Google what is the S&P average over the course of 10, 15, 20 years, is that 8 to 10% range, which is real similar to our returns, that 10 to 12 range. So it's not so much the returns of why people diversify, because I think in the long run it's somewhat similar, or at least in the same ballpark. But I think it's the fact that, at least in the private lending world, and again, we have a real estate debt fund, a hard money lending fund, where we lend majority to fix and flippers and to builders that are involved in ground up construction projects, and their returns tend to be that 11-12% range. But the reason people allocate to private lending route, or at least our route, is there aren't as many spikes, at least so far. There haven't been as many spikes. It tends to be a bit more consistent, 10, 12, 11, 12, 13% range. It's all right here with the stock market, the S&P. It could spike up one year, it could be down one year. So even though the course of 15, 20 years, maybe the returns are somewhat similar, but the volatility is a little bit different. So like me, myself, I have a healthy amount in publicly traded companies. I have a healthy amount, the majority actually, is going to be in our hard money lending fund, our real estate debt fund, parallel. But I like having a healthy amount in each for what my definition of healthy means for me. And it's different for everyone. Some have more in the publicly traded companies, some have more in the alternative field. Number two, I think people just like doing something different too. Just like it's a psychology thing. If money's going to be somewhat similar, then I think people just like being involved in something different, right? Something maybe where they can talk to the operators or the managers, compared to these publicly traded companies. You can't reach out to some of these big CEOs and talk directly to them. So I think some just like being involved in the alternative space. It's a little bit different. And then number three, some people just like investing to learn about something different, right? It's hard money lending is a very different investment vehicle than the publicly traded companies. So I think they just like to invest in something different to learn about it, right? So you have number one, I think it's just a good allocation where it's maybe not as spiky as maybe the S&P, and they view it as a way to diversify. Number two, they just like investing in something different. It's kind of cool to do, and they can probably talk to the founders. At least our fund being smaller, they can talk to us on a daily basis. And then number three, just to do something different, just to learn about it. So those are several reasons why investors, at least in our fund, tend to diversify beyond stocks. Again, they probably have the majority in the stock market, depending on who you talk to, but they like having some diversification in these different asset classes. Again, not financial advice, not investment advice by any means. We just talk about what we see on a day-to-day basis as it relates to our fund. So if you like this type of investment, financial content, please consider liking, sharing, subscribe to the channel. It helps us grow. Again, we put this out on a daily basis, on a weekday basis. So thanks for watching. Subscribe, all that fun stuff. We'll see you next time. Peace.